So today we'll take a deeper dive into market structure. I will be guiding you in your journey to take a step closer to really understand market structure. Market structure refers to the overall movement. It includes trends, reversals, and consolidations. Now ICT and SMC, they focus on higher highs, higher lows, lower highs, lower lows, and a downtrend. But actually there's more to it. And that's why I want to make this video and take you through that. So why market structure is important. First of all, it brings you institutional focus. It will give traders the insight into how smart money operates. This helps align with profitable moves. Now, this will give you the first insight, okay, what is the direction smart money, a lot of institutional money, is going. So what is the direction they are pushing the market at? If you follow a market structure, you can try and tag along, right? That's the whole point. You cannot change a market direction, especially not in forex, but you have to tag along on the right side. It is price action based. It avoids reliance on lagging indicators. Instead, it focuses on real-time analysis. It will give you a structured approach and it provides clear guidelines for liquidity and manipulation. This helps traders avoid common traps. Definitely something we'll get into more in depth in a second. Now, I created something and it's called the market structure framework. Basically, step 1 till 4 that you need to do in order to trade this effectively. First of all, you want to identify the trends. You want to use higher highs and higher lows for bullish trends, lower highs and lower lows for bearish trends. Now, you want to determine the liquidity zones. Very, very important. You want to look for swing highs and lows and equal highs and lows. And you want to identify where retail traders will place their stops. So in a market, let's say we're in a downtrend, you have a double top. This is a very common area where traders will put their stop loss. It is something that everyone has learned in the trading books, in the trading education received online, and it is just a common given. Stops above resistance or below support, right? And that is something that you will generally want to look for because these are really places where stops are being collected in the liquidity pool. So you want to spot institutional order blocks, find consolidation areas before sharp moves, and mark these as zones of interest. Very important because these order block is a block collected of orders where price tends to go back to a lot of times. Then you want to wait for confirmation. So wait for price reactions at key levels and use candlestick patterns or a market structure shift to confirm entries. Now, some key ICT concepts I think you can't miss in market structure or basically that you want to use together with market structure. First of them, very easy, liquidity. It is found at swing highs and lows, equal highs and lows, and fair value gaps. Institutions need liquidity to execute trades. So if you're moving around a lot of money, you cannot do that without having a lot of counter liquidity, right? You need a lot of, let's say, buys in the market if you want to push a massive sell and vice versa. Smart money will always hunt for liquidity if there is a big move following up. Now, institutional order flow. Institutions leave footprints as order blocks and breaker blocks. These signal potential reversals. Again, very good confirmations to have or things to see in the markets to pay attention to. Then market manipulation. Markets are manipulated through stop hunts and fake breakouts. These trap retail traders. What I told you before, these equal highs, equal lows, very good place to put your stop loss, you would think. And that's basically where everyone puts their stop loss. But then you get that stop hunt only for it to move in the right direction afterwards. Now, something important is swing structure versus counter trend trading. Basically, the two directions you can take with your trading position. The first one is swing structure. Trades with the trend direction and focuses on capturing larger price movements between swing points. So you're basically following the trend. Generally lower risk due to trend alignments and effective and clearly trending markets. Now, the other one is counter trend trading. Takes positions against the current trend, bets on price reversals at exhaustion points. Higher risk, but potentially higher rewards, often used in ranging or consolidating markets. And I think it is very important to have a combination of both in your arsenal. As if you're only focusing on swing structure, for example, you will not have as many trades, and less trades is not always bad. It can be a very good thing actually. But what I see often also with my students is that they can't sit on their hands for this long, right? So you want to have some filler trades in there, maybe even a 1/1, 1/2 position sometimes, just to have your mind also analyzing the other side of the trend, right? That counter trend trading. By the way, speaking about my students, I'm accepting 5 new one-on-one students this month. It is a one-on-one program. It is not just a course or whatever. I'll basically hold you accountable, hold your hand along the way, until you are a profitable trader. How do I measure your profitability? Is if you get a profit payout within the next 90 days. If you don't, I keep coaching you for free until you do. Check the first link in the description to book a call with me to see if we're a good fit. Now, last but not least, before we move into a live example of this, I want to show you some important ICT tools. Again, some things you have to add to your arsenal, I believe, in order to get the most out of this. First one is fair value gaps. Gaps in price action that act as magnets for price. These are inefficiencies in the markets. Second one is order blocks. Key institutional levels where price is likely to react, found at the base of significant moves. And last but not least, liquidity voids. Areas of rapid price movement that may be revisited. These show institutional interest. And I basically made this slide step by step so that we can revisit it once we're going to use this in the live markets. First of all, you want to analyze the overall trends. Identify if the market is bullish, bearish, or consolidating. This will set your directional bias. Then you want to mark key levels. Highlight swing highs and lows, order blocks, fair value gaps. These are reaction points. You want to watch for liquidity hunts. Look for stop hunts or fake breakouts around identified levels. These trap retail traders. You want to wait for confirmation, use price action to confirm entries, and look for shifts in market structure. Then you want to enter trades together with smart money, right? Following that same direction. Align trades with institutional order flow. Avoid following retail sentiment. That's something maybe off topic, but something that I want to add into it is on TradingView, you can often see what the overall direction is of the market. And I will see very, very often that I'm short and, for example, it is 80% long on Euro USD. Then I know, okay, I'm definitely avoiding retail sentiment and potentially I'm also following the smart money. So that there's almost like an extra confluence. If I'm against what the TradingView is saying that most people are doing, it's a good thing for me. It's a good thing. So let's put this into practice. I will hop into FX Replay. It's a tool I use for backtesting. And we will go over this step by step and see what trades we can get. Okay. So we fired up a new session on FX Replay and let's get into what we were discussing. So first of all, we want to analyze the overall trends, right? Analyze the overall trends. So what we're going to do is we're going to zoom out to the daily, maybe even the weekly to begin with, and see what price is going to do. Price is dropping right here and we are climbing up on the current weekly move. Now we are dropping a little bit lower, but as you can see this week we are a bit rebalancing this move. Now, this is Euro USD and we are at 1st of March 2023. And obviously, I know what is going to happen, right? I've traded this live and we're going to break this low. But I can't completely remember what happened here, price action wise, day per day, of course. Now, even though this is backtesting, I can definitely remember that I was telling my students back then, and also using this for my own analysis, obviously, that this low was very, very important. Because as soon as we were about to break this low, we would shift market structure. And this then was the whole theory for me that Euro USD was going to go lower eventually. It took 2 years, but we went lower and that's where we're trading right now. Obviously, Trump being in office changed a couple of things and now we are reacting pretty bullish on Euro USD, but that's besides the point. Let's go into the price action, but that's just something that I wanted to say. I've seen these charts 2 years ago now. I know the overall direction, but if you look at the weekly, if you look at the daily, you can see the overall direction as well. So it doesn't really matter. So this one is definitely a low that is very, very important and we don't want to see broken if we are remaining bullish. But if you know me a bit longer than today, I'm a big bear. I want to sell. So I will always be looking for selling opportunities, and I do believe that dollar is very, very bullish then for me to be a seller on Euro USD. So that is definitely something that I want to be looking for almost all the time. It is a bit of a bad habit, but in this case, I would definitely look for sells. So what are we going to do now? We identified that the market is bearish. Now we want to mark key levels, highlight swing highs and lows, order blocks and fair value gaps. These are reaction points. So let's do that. What we can see right here, we can see an order block right here on the daily. We obviously see this fair value gap on the daily. We already tapped into this one. And we see a smaller fair value gap down here, but this one has already been filled. That's about it. This is a swing high that we have. And that's about it, I guess, on the daily. Let's check the 4 hour if we missed anything. So on the 4 hour, we have some bullish fair value gaps, but I don't want to really pay attention to those as we are bearish. So this one is an important one. And by the way, this is that counter trend trading that I talked about, right? If you now want to be buying into this position, if you want to take bullish positions, you are going to be in that counter trend trading position. And then you are paying attention to these fair value gaps, right? Because this is something that you want to buy off from. But now for backtesting sake, we're just going to do on a higher time frame. But let's say realistically in the live markets, I do want to buy from these fair value gaps just to take price a little bit higher. Let's go to the hourly, and as I can see right now, it is 3 o'clock, and I don't trade the New York session, or not that often at least. I do like London session. So what I'm going to do, I'm going to go straight up to the next London session and see what we're going to do there. So price moved away from this OB, right? Moved away from this OB. We still have this swing high up here. Price is moving lower and is creating bearish fair value gaps. So this is telling me, okay, this might be the move already. We might be respecting this swing high right away and just respecting this OB as well. So two things that can happen right now. Or we're going to go straight lower and basically breaking this low, because this is definitely the ultimate target for me, as this is the low that I want to see get broken. Or we need some more liquidity, and we're going to bounce somewhere up here. So what I want to do is I want to go in the 15 minutes, because that's the next step. And we don't want to watch for liquidity hunts, right? Look for stop hunts or fake breakouts around identified levels, and these will trap retail traders. They want to wait for that confirmation, and then we want to enter the trades together with smart money. So right now we want to see a confirmation, or basically first of all we want to see that liquidity hunt, then we want to see that confirmation. So let's see what price is going to do. And let's watch this on a 5-minute actually. All right, so we're creating lower lows, we're creating lower highs. We could argue that this right now is a liquidity grab on a 5-minute, and also on a 15. Yes, we are taking out that high. So now we want to see a confirmation lower. If we see a confirmation lower, this is definitely a trade that I would like to enter, and want to take it, I don't know, somewhere down here, or maybe pausing at this point. Then I want to see how we react there. If we do well and if we go through it, then I might take my TP all the way down here. Let's see, 5 minutes, and I want to see the confirmation by having a big candle or a market structure shift. All right, we have a very huge candle right here. Let's see if we can enter right away. I want to put my stop above this high, because this high was broken by this liquidity grab, and I do believe it is going to respect this previous high. Then let's go to an hourly, and let's see if there is something that could sabotage us, so to say, down here. Oh, I think it is a good straight way down. There are some bullish fair value gaps up here that if we are wrong about the trade, they will definitely take us higher, and then I think we will take out liquidity, then move lower. So even if that's going to happen, let's say that it's going to happen, that it goes to stop loss, then I have another chance right here, maybe later today or maybe tomorrow. So let's go for this trade. And that is something that I like to do as well, guys. If you take a position like this, I always calculate, okay, let's say we are wrong, where can I enter again? Maybe today, maybe tomorrow, to have another chance. And this is not always the right way of thinking about this, as a lot of people will go very, very wrong with this. But if you do this, and if you do this correctly, if you are able to be disciplined and only going to be entering position whenever you are at that point, then you can make your money back plus a lot more if you lost that first trade, of course. So let's see what is going to happen. Let's put a bit more speed behind it. All right, so we are dropping very, very good. Let's put the stop loss on break even, as we're at 2R. And now let's pay attention to what price is doing and if we are bouncing or something. So we have this OB right here. We tapped into this. We did not tap into that fair value gap. So we have this OB. We might be reacting to this one, but let's see. Okay, price at take profit. That's a nice 1/3 to start off with. That's a nice 1/3 to start off with. You don't see my P&L, do you? No. So at the bottom right here, I can do this. Yeah, there we go. Sorry, I'm figuring this out on the go with you guys. You can see my P&L down here, right? It's 10K300. So nice 3% gain right here. Now, it is important to see what price is going to do once this TP is hit. We are actually already through the New York kill zone. So let's go straight away to the London session. Let's not waste any more time. Okay, went up a little bit higher, went through the TP once more, and is now, as it looks like, it is moving up higher. So, free tip for you all. Whenever you're moving away from a liquidity point like this, you want to see it take out the next one. So this one is the next one. If it doesn't, you will very, very often see the price comes back to take out this previous one to then try it once again. So that's actually what I'm expecting right now. I'm waiting for price to take out the previous one, and then I want to take a position lower. I don't like to trade it up there, to be honest with you, but I do like to wait for it. What I'm going to do, I'm going to sit this one out, and I'm going to wait for the next London session. This is also Friday. I'm going to go to the next London session, and this is the next week then. All right, this is the next week. This is a Monday. I don't like trading Mondays as well. I'm expecting it to go bullish, but I don't do anything with it. There we go. We are bullish, and it looks like we're going to take out this high. It is 5 p.m. So again, I go to the next London session. There we go. We have taken out liquidity. We're moving lower, and we're creating a lower high. See, like this. So if we're looking at this, liquidity on, check, confirmation, if it look like this, already check. And we want to trade it together. So we want to, again, take a short position from this. So right now, the only thing for me is that it is a bit early, right? That is right before Frankfurt. I would like to wait for, as I've seen that I have a lot more better results when London Open hits than entering it prior to that. So what I'm going to do is I'm going to wait for that to happen. And as you see, we have another liquidity grab right here. So I'm glad I didn't enter. And the next one I will enter. So this candle, I do want to enter. If, let's say, we're breaking the low of this one again, and we can put the stop loss somewhere around here, because if we're now moving above this high again, we're most probably wrong, right? We took out liquidity with this one. We took out liquidity with this one once again. I don't see it coming up there unless we're wrong. So now we can start targeting these lows once again, and I want to try it once more, right? To be honest with you, this one right here was the high that respected this OB. It was not enough to bring us lower below this low, so it created a higher low. This one made a new high to take out liquidity from here, collecting a lot more orders. Now it consolidated right here, took out liquidity from its own move. I think this could definitely be a home run trade right here, and I think it will be a perfect showcase on how to use market structure effectively if this one goes right, obviously. So let's place the order. It's going to be a stop order, and let's see what price is going to do. I want to put it on break even once we hit 2R-ish. So that's most probably going to be after this dip. Oh, wow, it is a very big dip right here. It's a Tuesday at 6, so maybe it's, what's that going to be for news? It is probably a news event, but maybe it's job loss or something like that. Anyway, let's put the stop loss on break even. And right now we are below, almost below this low. So let's see. Oh, wow, it's one straight way down. Wow, okay, very nice trade. And like I said, I think it is a very good case study of how to use market structure effectively. Right here as well, right? Even though we did not take a trade long, we did see it coming, right? And I didn't see the probability in there as it was a counter trend trade, in my opinion. So we waited for the bigger trades. And with doing this, you're basically taking a 15-minute entry, but you're basing it on a 1 hour, 4 hour structure. And I think that's just killing, right? I think, to be honest with you, we could have even dragged it here. Let's see. Yeah, we could have even dragged it there. So amazing, amazing trades. Following structure, following basically the principles of liquidity as well. And I think this was a perfect case study of how to use this in action as well. Yes, these are backtested results, but this is also how I analyze it in live action. Might not be as clean, but this is like maybe a once in a X amount of time trade, but it is a very, very nice one and definitely a very good case study for this lecture. So I hope you learned something, and I will see you in the next one. Bye-bye, guys.